Hey guys, my name is Seth, and through my PechaKucha, I have to demonstrate to you the importance of being financially literate. Take a second and try to think, what connects virtually every job in the world today? The answer is money, which makes it all the more puzzling that 76% of millennials, that's us, lack basic financial knowledge. Due to this shocking fact, I'm calling an emergency meeting. Guys, I promise you, you do not have to be Warren Buffett to make your money work for you. As we approach the end of our undergraduate careers, we need to understand the importance of staying on top of our financials now so we can reap the benefits later. Now, before I jump into my recommendations, let me address why you should listen to me. Well, aside from the fact that I'm a double major in business administration and economics, the following avenues of investing are recommended as safe and consistent ways to obtain wealth by successful investing companies like Vanguard and TD Ameritrade, websites such as Investopedia. Now let's begin very simply by defining investing. Investing is buying assets or resources with economic value like bonds or stocks that you believe will grow in value in the future. And if you're wondering, a stock is merely a share of ownership in a company, and a bond is like an IOU given to you in exchange for money now. And after its expiration, you'll be compensated for your money plus a little extra, which is specified interest. Now, these are just two small ways you can invest. Most people invest in accounts that are very diverse or full of a lot of different kinds of assets because it lessens the risk that they lose money. On average, a diverse portfolio of assets will earn about 6 to 8% yearly compounded interest. Now, this might seem like a lot, but a compounding interest rate of 7% takes just over 10 years to double. It's not that long. Now, as you'll see in the next graphic, saving early and saving often can far exceed what someone who saves more later could do due to this compounding interest. For example, if you saved $150,000 from 25 to 40, by the time you're 65, you could be a millionaire, as opposed to saving later where you would not reach the same heights. So how do you do this? What kind of accounts do you use? What's the plan? Well, before I jump into the two main types of retirement accounts, we first need to remember that life is messy and things like, I don't know, a global pandemic can hit overnight. Too soon? Sorry. But really though, it's true, and most people aren't prepared for any level of emergency. For example, 40% of Americans don't have enough cash on hand to cover a $400 emergency. When that cost rises to $1,000, 61% of Americans would be unable to afford it and would go into debt. That's not even a major emergency. So, to begin, you should start an emergency fund with $500 with the aim to hit $500 in the event that you blow a tire or drop your computer and need it repaired. As you enter into your professional life, that number should increase accordingly. And realistically, you should look to have 6 to 10 months of expenses saved up in case you were to lose your job. Once you have this done, you can begin looking to the future. As simple as it seems to know you need to save for retirement, on average in 2013, 56 to 61-year-olds only had $17,000 total saved up for retirement. That's less than a year's tuition at Lyon, guys. So, how can we do better? Well, we're going to examine the two most popular types of retirement accounts. Those are the 401k, which is a company-sponsored retirement account plan, and the Roth IRA, which is a retirement savings account. I know these names sound complicated, so I'll break each one down individually. With a 401k, this is job-based. So once you get your first job, you're likely to be offered a 401k or something similar. Now, as I said, this is simply a long-term investing plan that you can use, which has replaced things like pensions of old. Now, 401ks usually consist of a combination of assets like bonds and stocks. And the primary benefit of such an account is that usually the company will match a certain amount, around 4.3% on average, of your income that you put in. So they will offer you up to 4.3% of free money from your income if you match that same amount. And the second advantage is the money you put into the account is taken out of your salary before tax. This means you'll be taxed less since your income is technically reduced in the short term. Now, on the other hand, is the Roth IRA. As I said previously, this is simply another kind of individual retirement account. However, it's not company sponsored, and therefore a Roth IRA can be opened with virtually any financial institution. They're particularly advantageous to young people like us because the money put into that account is already taxed. So and you take it out later, there is no tax. Additionally, Roths generally give you more freedom in your investment options. And finally, this account has what is called no minimum distribution, which means after you retire, you're not required to take out a certain amount every single month. So, how do you take advantage of both of these options? Well, I call it the hamburger method, though that's not the official term. But as you can see, if you invest in your 401k up to your company's match, then go over to your IRA and max out your contribution to that, and return any remaining money to your 401k, you will be maximizing the benefits you can receive from both accounts. Now, these are by no means the only ways to invest, but they are some of the safest. So to recap, you need an emergency fund. You should check out 401k or similar options depending on your field, and you should look into a Roth IRA. Now, in conclusion, I encourage you to do your own research and really invest in yourself by becoming financially literate. There are a ton of free resources available to you, and the earlier you start, the better off you'll be. Because the truth is, financial problems are not fixed with money, but by becoming financially educated. So I encourage you to invest in you.